Chairman of the European Systemic Risk Board. So I will give immediately the floor to President Draghi.
Mr. Chairman, honourable members of the Economic and Monetary Affairs Committee, ladies and gentlemen, it's a great pleasure for me to appear before this newly constituted committee in my role as chair of the ESRB. For those of you who are newcomers, I trust my comments will provide an informative introduction to the work of this important body. The ESRB plays a key role in delivering a healthier financial system, which is a necessity for achieving a sustainable recovery in Europe, and today I would like to update you on our activities. European authorities have worked hard to rebuild confidence in the banking system. These efforts culminated in an EU-wide stress test, coordinated by the European Banking Authority, and the comprehensive assessment of significant banks conducted by the European Central Bank. The ESRB has made an important contribution here and plans further work in this area. It designed the adverse macroeconomic scenario for the stress test. It will reflect on the results of the stress test and consider the possible implications of banks' responses for macrofinancial developments. The ESRB is also examining the systemic implications of so-called misconduct risk in the banking sector, i.e. the risk that banks are subject to fines and other sanctions due to violation of good conduct rules. The character of misconduct risk and the increasing size of the fines create uncertainty about the business model, solvency and profitability of banks. The systemic nature of this risk derives from a number of factors. In many cases, misconduct issues arise across markets and also at systemically important banks. The costs typically rise in times of crisis and, as such, have a procyclical effect. Finally, misconduct can damage confidence in financial markets and institutions, which is vital for the proper functioning of the financial system. For all these reasons, the ESRB plans to devise, together with the EBA, a minimum methodology for banks to apply when calculating potential misconduct costs under stress. This will ensure a robust, rigorous and comparable assessment across banks and a consistent approach and appropriate contingency planning across jurisdictions. Misconduct risks should also be adequately captured in future EU-wide stress tests. Let me say something about macroprudential policy in the banking sector, and perhaps I will be addressing one question which was asked to me before. Since about 1 year, new prudential rules for the EU banking system, the so-called Capital Requirements Directive and Capital Requirements Regulation, CRD4 and CRR, have entered into force, establishing for the first time new macroprudential instruments such as the counter-cyclical capital buffer. In June 2014, the ESRB issued a recommendation on how to set counter-cyclical capital buffer rates. Decisions should be guided by the objective of protecting the banking system against potential losses associated with the build-up of cyclical systemic risk. Thereby, they would support the sustainable provision of credit to the real economy throughout the financial cycle. The recommendation advises on how authorities should use the deviation of the ratio of credit to GDP from its long-term trend as a common starting point in guiding decisions, in particular for the build-up phase. It also identifies cases when other indicators should be used, like measures of stress in bank funding markets and indicators of general systemic stress. Against this background, the first countries have notified the ESRB of the introduction of a counter-cyclical capital buffer rate, which stands at 1% in Sweden and 0% in Czech Republic, Slovakia and the UK. The ESRB also reviewed a recommendation addressed to Member States aimed at creating a common framework for national macroprudential authorities. This recommendation has helped establishing institutional competence at the national level and improving the effectiveness of the macroprudential function. In general, the ESRB is satisfied with the degree of implementation, but I would encourage those member states where the implementation process has been lagging behind, i.e. Italy, Luxembourg, Poland, Romania and Spain, to step up their efforts and put into place national legislation as soon as possible. Across the European Union, different institutional models have been used. In most cases, macroprudential powers have been attributed to the central bank, as recommended by the ESRB, in some cases to the supervisory authority, and in a few cases to committees chaired by the government or to the government directly. Over the past year, Member States have actively made use of the new macroprudential framework. The ESRB has taken a close look at around 30 national macroprudential measures. Broadly speaking, the measures implemented seem to be of two types: those aimed at addressing excessive credit growth and leverage, and those tackling the systemic risk arising from banking groups that are large and complex. The counter-cyclical capital buffer that I mentioned earlier belongs to the first category. While this buffer is helpful regarding credit developments in general, it is less suited to address credit developments limited to specific sectors, such as real estate. Consequently, several member states have implemented measures aimed specifically at the real estate market. For example, in Belgium and Sweden, banks are required to set aside more capital for mortgage lending. In contrast, other member states such as Hungary, Ireland and UK have introduced stricter criteria for borrowing, such as limits on loan-to-value, loan-to-income and debt service-to-income ratios. The second category of measures focuses on solving the too-big-to-fail problem, mainly by introducing higher capital requirements for banks likely to threaten the stability of the financial system in case of failure. Member states such as the Czech Republic, Denmark, Croatia and the Netherlands have followed this route. Mr. Chair, honourable members, let me conclude with a brief look into the future. Now that the EU-wide stress test has been completed, I would like to focus in particular on risks outside the banking sector. Market participants and authorities across the world are devoting increasing attention to the risk that normal cyclical volatility in financial markets might be artificially amplified by insufficient liquidity in some pockets of those markets. Liquidity services are typically supplied by specialized market makers, who for that purpose hold an inventory of the securities that are traded. A number of factors have led to a reduction in those inventory holdings. Technology permits market makers to roll over lower inventory holdings at a higher speed, for example, through high-frequency trading. Higher competition may also have led to holding lower inventories, as market making is now considered as an autonomous business center and is not always profitable in all market niches. Finally, the multiplication of trading venues through technology and regulation implies that the same inventory often serves multiple venues, each with its own features. In contrast, the demand for liquidity services has increased above all due to the increasing importance of asset managers. Both passively and actively managed assets require higher liquidity services. Passively managed strategies like ETFs, because asset managers need to track market movements by buying or selling assets. Actively managed assets because of a tendency to trade more frequently. As a result, with less supply and more demand, effective market liquidity may have become thinner in a number of markets. Interconnected asset markets can then easily propagate such liquidity shocks. In recent weeks, a number of sudden market movements originating in the US and propagating in EU markets had exactly this nature. The SRB will investigate this issue further, and I anticipate that I will be able to brief you on the results of our work at our next meeting. Finally, I would like to note that we will publish a report early next year on the regulatory treatment of sovereign exposures. It is, to my knowledge, the only study conducted by an official institution on the systemic vulnerabilities arising from sovereign exposures. It will provide a good overview of the current and future regulatory framework, the specific risks, the scale of banks' and insurers' exposures to sovereigns, also benefiting from recent data published on the occasion of the last stress test, and the possible economic consequence thereof. The report will also identify possible policy responses that could be applied in the medium term. Thank you very much for your attention.
Thank you very much. Many really relevant topics. Unfortunately, we don't have much time, so I will ask you, colleague, I will tell colleague we will reduce the slot to maximum 4 minutes, if possible less. So the first speaker is Georgis Kritos.
Thank you, Mr. President. I have 2 questions for President Draghi. Is there a danger of supervising in an exhaustive way the banking sector without adequately supervising shadow banking, and thus increase instead of decreasing systemic risks? And another question, what about the policy of US authorities which impose huge fines in the range of billions on major US and European banks? Does this mean that we should apply a stricter regime in the European Union in order to avoid unfair banking practices, or should we protest to our American friends for creating additional problems to the functioning of the European banking system? Thank you.
Thank you. Well, certainly on your first question, certainly market intelligence, all kinds of market intelligence signal that the financial sector is transferring risks from banks to non-banks. Simply comparing the main features of markets today with those of some years ago reveals the importance of new players. For example, the non-bank, non-insurance activities. Important is also the growing non-traditional activity of insurance. A few years ago, the focus was on hedge funds, which in the meantime have proved to be more resilient to vulnerabilities than expected. So this Parliament has already started to work at several issues. First of all, money market funds. As you know, we have issued a recommendation on it in 2012. OTC markets. And it's clear that we need to complete the legal agenda and submit all market segments to equivalent types of surveillance and to the necessary regulatory requirements. Let me add that it's not only the SRB, but that's the worry, that the concern that you've expressed is widely shared at global level, and work is being done at the FSB level as well. On the second point, it's pretty clear. I think recent events have shown that it's pretty clear that, first of all, misconduct by banks is a real problem. It's not been invented by the various judiciaries. Second, that the present legislation concerning correspondent banks is very complicated. Third, that these internationally agreed sanctions are being implemented by the various judiciaries in different jurisdictions in a very different way, so that global banks feel subject to different jurisdictions and different judiciaries and different implementations and different fines, depending on where they are being judged. So I think there is vast scope for coordination at global level of, well, at the very beginning, when these sanctions are being written, they should contain, because after all, they are the main legal document, they should contain provisions on how harmonize is a very strong word, speaking of judiciaries, but at least showing what the compatibilities are, working about making them a little closer than they are today.
Thank you. Jakob von Weizsäcker.
Yes, thank you, Chair. Mr. President. I'm delighted that you're going to look at the systemic vulnerabilities of sovereign exposures. I think that will be a fascinating read for us. I have two questions. The first question relates to the stress tests. In your function as chair of the European Systemic Risk Board, you might have noticed that systemic risks in the stress test did not feature prominently. In fact, they did not feature at all. And I would be curious, in that function, not in your ECB function, but in that function, how would you view the decision in view of future, perhaps, stress tests of not including systemic elements? That would be my first question. And my second question relates to a fascinating report that was prepared by the Advisory Scientific Committee of the European Systemic Risk Board under the title, it asked the question, is Europe overbanked? It was published in June, but as I believe this committee hasn't had a chance to discuss it yet with you, I wanted to ask you some question about it, but before I do that, I just want to read a quick passage of this report. We are not the first doctors that the European banking system has consulted in recent years. Our patient has just taken medicine on BRD, SSM, SIM, and so on. Indeed, our patient has grown tired of this medicinal onslaught. It has developed therapy fatigue, but in our view, more is needed. Some therapies could have high dosage, others have not been tried at all. We think that a course of new treatment will brighten the prognosis, helping the European banking system to make a speedy and lasting recovery from its current bloated state. And it goes on to explain that indeed there is a bloated state because European, especially large banks, have grown much, much quicker than GDP in size and much quicker than their US counterparts, and calls for therapies including antitrust legislation to deal with that. Now, the reason why I'm bringing it up, because I'm currently working on bank structural reform legislation, of which some people have been critical. We are eagerly waiting your report. But from the point of view of the European Systemic Risk Boards, would you agree with the claim of that report of the Scientific Advisory Committee that there's a serious problem of overly large banks in Europe that needs to be addressed? Thank you.
Thank you. You raised a number of points. The first on the sovereigns. The sovereigns have been actually stressed in the stress test. The point here is what are we going to do in the future? You know that there is a very interesting report by the Advisory Scientific Committee, which is going to be published next year, and that does suggest a series of policy measures that could address the sovereigns in the bank's portfolio, the excessive concentration. And these measures, these proposals, would range from stricter capital requirements to diversification requirements to Pillar 3 and enhanced disclosure requirements, and for insurance it suggests changes to Solvency II. Let me add that this is extremely important because we've, in a sense, experienced how serious could be the nexus, the link between sovereigns and banks. So, in this sense, it's very well-minded. But we have to also to understand that these changes, like, for example, the changes in the national options, which I was hinting at before in the previous presentation, how to treat the goodwill in different banks, how to treat the deferred tax assets, how to have a level playing field for risk-weighted assets. All these changes have to be agreed, possibly at global level, in order not to create an adversely uncompetitive environment in the European context. So I think this a lot of work is needed at the Basel Committee and the FSB. Where I should add perhaps that the overall climate is not hostile at all with respect to these changes. So I'm not saying this in the sense that we find a hostile reception to these changes, not at all. But there is need to have a global level playing field for these changes. On the second report you mentioned, it's actually, I agree with you, it's an excellent report, and it will be discussed. We already had a conference seminar in the ECB on this report, and we'll certainly study and reflect on this. There is a lot of truth into this, but we have to be more specific than just saying there is a lot of truth. My personal feeling is that there is indeed a lot of truth.
Thank you. Next speaker, Kay Swinburne.
Thank you, President Draghi. As part of the EMEA negotiating team here in the Parliament, I believe that the G20 mandate on making the trading, reporting and central clearing of derivatives is an important step to both monitor and manage the systemic risk arising from these global products. However, as we move to mandate the central clearing of a broad range of derivative products, we are now concentrating risk in these CCPs, making many of them systemically important critical market infrastructures. So given last week the FSB published a report on its latest work on systemically important financial institutions, suggesting a TLAC, a new acronym, Total Loss Absorbing Capacity Measure, many of the banks that are subject to that potential TLAC are also the biggest clearing members. And given that we also in the BRRD have a measure very similar called MREL, then should we now be looking at using a similar loss-absorbing capital measure to prevent CCPs from becoming the next too-big-to-fail institutions?
Well, the answer is yes. I wholeheartedly agree with what you said. TLAC is a key measure in responding to the too-big-to-fail issue and making sure the losses in case of failure are being borne by shareholders, creditors, and not by the taxpayers. So the ECB supports the FSB proposal requiring that the G-SIBs hold the total loss absorbing capacity of between 16 and 20% of their risk-weighted assets, or a leverage ratio of greater than 2, as a minimum Pillar 1 requirement, subject to a thorough impact study, quantitative impact study, and market survey. So we do support, and now, as you know, the FSB has started the calibration exercise where we are, and we are cooperating with this. Thank you.
Sorry, can I just ask if you would apply that to the CCPs?
Well, I would have to check on this. Offhand, I would say that there are good reasons for that. But has the FSB made a proposal to apply TLAC to the CCPs? I'm not sure. I don't think so. But I am not in a position to give you a definite answer to that.
Thank you, Cora von Juent-Oizen.
Thank you, Mr. Chair. Mr. President Draghi, I also have two questions for you. Over the past few months, the ECB has reduced interest rates to record lows. It has also indicated it is looking to substantially expand its balance sheet, including by outright purchases of securities through the CBPP3 and ABSPP programs. We have heard speculation regarding the purchase of corporate bonds and even sovereign debt. In Italy and Spain, we have seen increases in the issuance of junk corporate bonds in response to investor demand for yield. Do you share the concerns voiced earlier this year by several central banks, including the Bank of England, the Fed and the Bundesbank, that an ultra-loose monetary policy is leading to complacency among investors and reach for yield behavior, which could create or fuel asset price bubbles and moral hazard concerns, especially in peripheral countries? Do you consider this a threat to macroprudential policy objectives? And my second question, under the new rules for bank capital requirements, countries are obliged to report some national macroprudential measures to the ESRB. In July 2014, the ESMR released a report considering these notifications, most of which had to do with countries imposing systemic risk buffers on their banks. These SRB buffers were used often as a substitute for ordinary systemically important institutions buffers, which is a dedicated instrument for specific institutions that cause systemic risk, but can only be imposed from 2016 onwards. In your review in July of this year, you indicated some concerns that many countries use the SRB and apply it generally to various banks as a substitute for ordinary SII requirements. What is the current trend on this, and are you concerned by this development? What measures do you want to see implemented to ensure the SRB is used properly by countries? Thank you.
Thank you. We're certainly concerned by the fact that the loose monetary policy could could produce higher risks for financial stability. And we've made this point several times. It's not only, and it's actually a bit rich, this point being made by the jurisdictions which expanded their balance sheets several sizes with respect to our own expansion. But certainly, let me differentiate three aspects. First, there are some categories of financial players which are the most exposed, especially the ones which guarantee fixed returns. And this is the case for life insurance, pension funds, and CNAV money market funds. Second, in a number of EU countries, there are signs of upward movements in real estate prices, partly due to structural reasons, urbanization, limits to new building, legal constraints in the rental market, taxation, but also partly due to abundant liquidity and search for investment. Third, excess volatility cannot be excluded. The low interest rate environment encourages for search for yields, which means that asset prices depend more upon sentiment than fundamental value. For the moment, we don't see, however, any systematic overvaluation. We see localized overvaluation. We have different estimates of real estate markets or different estimates of some asset markets done by us, by the IMF. They don't show an especially pronounced problem at this point in time. And of course, if we look at several past months, we also see that there have been corrections to these overvaluations. So we remain vigilant. But having said that, we think that our monetary policy stance is appropriate as far as our mandate is concerned, which is inflation below but close to 2%. And risks to financial stability, when they are of the nature that I just mentioned, should be addressed by macroprudential tools. That's the first line of defense. On the second point, it's true there has been use of the systemic risk buffer as a substitute for the domestic buffer for large banks. But it's more of a problem of procedures, and it's no doubt they are using the easiest ones. However, economically, we agree with the measures against too big to fail, and it happened in various countries, one of which is the Netherlands. Thank you.
Thank you. I need...
No, I'm fine.
I think we should group the questions because President Draghi has a plane to take. So I will ask colleagues to be as short as possible. And next question is from Matt Carty. We will group three questions.
Thanks, Chairman, and thank you again, Mr. Draghi. Just as a new member of the committee here, I'm still trying to get to full understanding of the SRB and the role that it could play. One of the things that has struck me, and maybe this was a debate when the body was established, was how closely aligned the ECB is and how central it is within the body, and the fact that you are chairperson of the board as well as being president of the ECB leads me to ask the question, is there or could there be a conflict of interest in in the sense that could decisions that are made by the ECB in fact in times lead to systemic risks, that there wouldn't be adequate oversight of that. Earlier on we spoke about the Irish banking crisis. There would be a very strong view in Ireland that I would share that the ECB actually played a role in the causing of that banking crisis. The Irish banks certainly overlent, but they borrowed the money of other European banks with either the knowledge or the tacit approval of the ECB. Just in terms of one specific question, you mentioned earlier on in terms of that the ECB would support capital markets union. Do you think, or do you see any possibility that that would increase the systemic risks? If so, what risks do you see or envisage, and how do you believe that they can be mitigated?
Thank you. Molly Scott Cato.
Thank you. I'd just like to say that it does appear to invalidate the D'Hondt principle that it's always the smaller groups who are getting their time cut. I don't want to make Mr Draghi miss his plane, obviously. So to my question, I'm sure, Mr Draghi, that you've seen today's Guardian newspaper and the report of the speech by Prime Minister David Cameron, in which he claims that red warning lights are flashing on the dashboard of the global economy. I assume that if this is right, then you are watching the same dashboard from the European Systemic Risk Board, and I'm interested in whether you are seeing the same red lights. In this context, I have a couple of questions I would like to ask you, one of which is political and the other is more technical. First, you mentioned yourself earlier on the importance of confidence and the important part that it plays, particularly in underpinning the stability of the financial system. Do you think that it is unhelpful for national leaders, whether inside or outside the Eurozone, to raise the spectre of a new financial crisis? Secondly, Cameron also mentioned the slow growth rates in the Eurozone, which are reflected in very low yields on sovereign bonds. Yet corporate bond spreads are also historically low, implying confidence in the financial strength of firms. Do you agree that such contradictory price signals mean that large losses are inevitable, whichever market signals turn out to be wrong? And can we assume that investors are anticipating that the ECB will act as a backstop? And what does this suggest about both systemic risk and ultimately the political risk to taxpayers?
Thank you. Patrick O'Flynn.
Thank you, Mr Chairman. Mr Draghi, I'm actually starting to feel quite sorry for you, because you are indeed like the doctor who administers every medicine and still the patient gets worse. But on the issue of systemic risk, you say the regulatory framework must be or cannot be pro-cyclical, I assume, in case it magnifies a cycle leading to unnecessary instability. But the problem comes when the cycle stops working altogether and you enter a prolonged period of depression, maybe even a lost decade, because this implies a continual relaxing of safeguards over a long period. So is it not clear that the structural failings of the Eurozone may become associated with long-term lax attitude to systemic risk? And instead of allowing safeguards to drop, why do you not simply tell Eurozone governments that the currency area cannot work as presently constituted? Thank you.
Thank you. I will start answering the last question first, if I'm allowed. But we shouldn't forget that actually the crisis didn't start in the euro area. Financial crisis, because of lax regulation, started in other countries that you know only too well. Now, coming to the other question, is there a conflict of interest between being chair of the SRB and being chair of the ECB? Well, I frankly have not seen one instance. Is it in the future? As you know, this arrangement should terminate in December 2015. What is the next arrangement? As I said on other times, I'm entirely in your hands. There is a proposal to make a managing director for the ESRB. If the ESRB continues to be rooted in the ECB, certainly the idea, this new role of the managing director, which will have the competence of which, by the way, will have to be coordinated with the actual the current secretariat and with the ECB. But if this is so, then it would make sense for the ESRB to maintain having the same president. But as I said, I'm entirely in the hands of the legislators here and the Commission. Would the creation of a capital market union increase the systemic risk? Right now, frankly, if we look at our past experience, it's exactly the absence of an alternative funding channel that increased the overall economic risk, the overall economic uncertainty, because one channel may get clogged. That's what happened to the bank lending channel. And at the same time, we've seen that the capital markets channel actually more than compensated the shortfall of the bank lending channel through both corporate bond issuance and equity issuance. So to have a plurality of channels that finance the real economy is probably a better situation than just relying on one channel only. On the second point, I wouldn't want to pass judgments or on what people say. People say what they feel like saying. Let me just go quickly through the main list of risks that we see from the ESRB perspective. The first is macro-financial vulnerability that comes from the interplay of low growth, low level of interest rates, high level of indebtedness of households, corporates, and sovereigns. This interplay of these three factors, low growth, low level of interest rates, which really pushes people to the search for yield, and the high level of debt of various categories of economic actors. The second risk could come from a global market repricing, the search for yields and sudden reappraisal of risk, possibly aggravated by the structural tight liquidity conditions in some market pockets. So this is a possibility. We are at the time when interest rates may change, and the issue is how would they affect the economy and the actors' response to it as a consequence of these changes. The third is there may be residual vulnerabilities in the banking sector's balance sheets, like, for example, the example I just made before, the conduct risks. The fourth element could be an aggravation of the sovereign crisis. Certainly, that's again, it impinges on the other point you made. How do markets react to the current sovereign bond prices? Are they reasonable? Do they reflect fundamentals or not? Well, the answer here is really to the extent that governments will continue in their fiscal consolidation and especially in their structural reforms, the current prices do reflect the current level of riskiness and debt sustainability. If we were to experience a sudden reversal, on the other hand, especially in the structural reforms area, and a continued low growth, the current spreads may not reflect that. We may have some structural vulnerabilities in the insurance sector, especially due to the low interest rates. And finally, we might have, and here I come to another question which was just asked, we might have structural vulnerabilities in the financial market infrastructure, namely the CCPs that have been just mentioned before. I'm just listing the possible risks. That doesn't mean that we actually see risks as materializing themselves. It's just that if you turn around and you ask yourself the question, where could the next crisis come from? This is a list of potential sources, but it doesn't actually say that we are actually seeing these risks. Thank you.
Thank you. Actually, it was a victory of the Parliament to have the chair of ECB chairing the ESRB in the trialogue. Last two speakers, Bernard Monod.
Merci. Monsieur le Président de la BCE, depuis le 4 novembre, vous êtes...
Thank you, President of the ECB. Since November, you've been the head of banking supervision in Europe with the SSM, and the most recent evaluation of the ECB on banking resistance has, according to you and your colleagues, been a success. But you're also the president of the steering committee of the ECB, looking at macroprudential conditions and the Eurozone. So you have a number of different hats, and therefore you have a considerable important role in the Eurozone. We have heard that there have been huge dangers identified by yourselves in the area of shadow banking and the subprime crisis which exploded a few years ago. Could you tell us why you have changed your policy on the high risk of shadow banking, which all of a sudden doesn't seem to be such a major threat, and why are you saying that securitization is one of the keys of your policy going forward? I'd also like to know about financial stability and the publication by the FSB of the annual list of the 30 large banks. Some of them are French, which are allegedly undercapitalized and therefore would not be able to survive the next financial crisis if there were one. I wonder whether in the ESRB you will apply to Cyprus the resolution mechanism that you've outlined, and wonder what will happen to the European citizens' bank deposits on these bank accounts, and what will happen in terms of the capital held by their banks. I wonder about solvency and the demands of the ESB in terms of capital reserves and the own resources of these mega banks, which are supposed to have at least 20% of their capital held in assets in order to avoid buy-ins. How are you going to ensure that they build up their capital to this level? I feel that an accommodating policy towards the private sector banking is detrimental to social democracy. And I feel that the European peoples are caught between Scylla and Charybdis, and the labour market is paying the price for it. Thank you.
Speaker Orkmark.
Thank you very much, Mr. Chairman. Sometimes when one listens to these discussions, you can get the feeling that the best thing would be that we had no banks at all, because then we would have no risks in the banking sector. But if we are to have banks, it would be interesting to hear from you how we are to interpret the experience we have had and also the stress tests regarding, would you say it would be better, we would be better off if we had more but smaller banks, smaller and more banks, or if we had, because that comparison is very often done, like in US, less of banking, less of financing via banks and more via the less regulated and supervised parts of the financial sector. I can imagine that one can hear that I'm aiming for something in this question, but I still is very curious about your answers.
Thank you. On the first question, if we look at what has happened in the banking sector in the course of the last, I would say, 7 years, since the beginning, since the onset of the crisis in the end of 2007, we see that many things have changed. Regulation has been completely redesigned. Much of this redesign has been implemented. Much also is still to be implemented, but the line of direction is now clear. The banking system is nowadays more resilient, certainly, than it was before. The last example is the TLAC that I mentioned before. Also, risk management practices and incentives have changed profoundly in the banking industry. So I would say that to say that nothing's been done would be an exaggeration. At the same time, I agree with you, we shouldn't be complacent about what we are doing, and we should continuously monitor and be vigilant about developments, because the financial services industry is everything but a static industry. And it's in this sense that now the attention is focused on the non-banking or shadow banking sector. The stress tests have provided a very powerful indication about the state of health of the banking sector in the euro area. and also have provided, for the first time, a lot of better, I would say, harmonization of definitions, like, for example, the non-performing loans definition. We certainly have to improve our practices in making measures of capital more comparable, and I mentioned 3 areas of work before. The first is the valuation of goodwill. The second is the valuation of deferred tax assets. And the third, most important, is the risk-weighted assets definition, and therefore the analysis of internal rating models by the banks, especially the largest banks. This answers partly to your point about the French banks. French banks have not come out as undercapitalized, by the way, according to the AQR and the stress test performed according to the existing rules. So this is just the beginning of a long journey towards really having not only one supervisor, but also one practice of supervision all throughout the area. On the last point was made about small versus large banks. It's a very, very difficult question. It's quite clear that if the bank is very small, the systemic implications are probably going to be smaller than having a very large bank failing. At the same time, it is shown that up to a certain size, there are economies of scale and economies of scope up to a certain point, which would produce better financing conditions for the real economy, both price-wise, quantity-wise, technical assistance-wise, and so on. After a certain point, however, complexity takes the dominance and makes the whole thing not only very difficult to manage, but also systemically much riskier. So it's very hard. And partly the answer depends also whom you ask to. If you ask the typical SMEs, they like small banks. They like small banks because they are closer to the client, they're closer to the land where they work, but also because there is a sort of relative power size dialogue there that takes place. While in the case of a very large bank, often the SMEs feels like a small man in a big universe. At the same time, very large banks often offer a variety of services which sometimes can be useful. So the other aspect that we have to consider, however, and this, by the way, your question impinges on what I was asked before, whether the euro area banking system is overbanked or not. It's partly the same question. The other point that needs to be addressed is the cost of having a banking system which is formed predominantly by small banks. If we look at certain countries have several hundreds of small banks, each one of these banks has a board. The board is formed by between, say, 5 and 19 people, and often the boards are highly politicized. The board member salaries are everything but small. Very often they range up to 100,000 and plus, 100,000 euros and plus. So these are all costs that in the end are paid by the client. So it's a very complicated question and it's one of the questions the SRB is looking at, by the way. Thank you.
Thank you very much to President Draghi. We look forward to the result of your work on liquidity shocks and also on your report on regulatory treatment of sovereign exposure, which you anticipated some element with, which are very sensitive, of course. The date of the next hearing on the SRB chair will be communicated to members, will be in 2015. Thank you again to President Draghi.
Thank you.